One thing that I think a lot about is at some point there will be treasury auctions on chain. Like this industry will grow large enough that the Fed will actually issue and redeem bonds on chain.
Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. Hello everyone, how's everyone doing out there?
Lou, what's up?
What's going on, fellas?
Just hanging out, having a good DAS. What about you?
Yeah, give us what's your impressions of the conference so far? This is a live Bell Curve episode. Do we have any Bell Curve listeners in the audience today?
Go.
All right.
Shout out that
Four
guy.
of us. Yeah, we got mice 1 and 2.
Mice 1 and 2 advance.
A lot of talk about stablecoins, a lot of talk about private credit. I think the big moment of the week was when Maker allocated $1 billion into BUIDL and other tokenized T-bills, and I think they're going to start aping, into like AAA CLOs with the $5.5 billion of USDC they have on their balance sheet today. So I think like the RWA narrative is certainly coming back, and just different types of bespoke private credit deal flow. And I think there's a good chance that Maker can get to $1 billion in earnings a year, and like nobody's talking about that because it's not kind of entirely crypto native, but it's important nonetheless.
Okay, let's talk about, we've sort of had maybe two segregated paths of talking here. One which is very focused on stablecoins and RWAs in a very permissioned, more traditional sort of route. And then we've talked a little bit about some more permissionless DeFi protocols. Maker is kind of at the forefront of merging those two worlds, right? It's a decentralized structure, it's unquestionably DeFi, but it's moving further and further along the path of RWAs. And also a trend that we haven't talked too much about, which is buybacks. So let's talk about both of those things. Just how you guys see Maker maybe as like very early in terms of front running the combination of these two different parts of crypto. And then let's talk about the importance of buybacks, especially when it comes to liquid tokens, which everyone has been pretty bearish on for most of this conference.
Yeah, that's dumb if you're bearish on liquid tokens. I mean, it is probably smart to be bearish 99% of liquid tokens, but you're looking for the outliers. And I think really the thing about, and it's now called Sky. It's not Maker anymore, so we got to like
Sky.
We got to
Sky,
formally
yes.
cut over.
Sorry.
We're just going to like terraform that in everyone's mind. But they're doing about $500,000 of buybacks a day, annualized pace of like 180, 190 million. The FTV of the token is like I think like 1.2 billion. So they're buying back like 15% of this thing a year, and it's the most important experiment that's going on today because if you can direct value directly back to token holders, there should be a price movement at some point, and market's down, whatever, the buybacks are going through at a price that's more favorable long term, but there's just going to be an undeniable impact at some point. And I think the even bigger thing is that, as they move out of just like stablecoins with no yield into T-bills, into AAA CLOs, into energy lending, which we'll talk about, the business model of a stablecoin is very simple. How many stablecoins are there? There's about 8.5 billion today in Maker, Sky. That's growing probably $1 billion a month. They could get to 20 billion of stablecoins and be earning, probably low teens on it. And if that happens, even if people are staking USDS, which, they pass back the savings rate to them, you could easily get to $1 billion of earnings. And that's what we're playing for. A real company is one that has $1 billion of earnings and nothing else really matters. And so I think it's possible to be bummed out about not everything working in crypto today. I think that's like one mental model, but there's only 7 in the Mag 7, and that's what we're really hunting for as venture capitalists, like finding those outliers. And they're there. You just got to be locked in and interested.
So I think we talk about this in the pod all the time, but like the next couple of years, the next couple of quarters is all going to be about dispersion. How do we separate the stuff that's working, the stuff that's not working, what has real durable value? But just to put a finer tooth on it, the way that these protocols, which are making money, that are actual businesses, pass back, there aren't that many options other than buyback and burn, or buyback and distribute, however you want to do it. But the buybacks are going to be what disperse, the selection of who's good, who's not good. Maker's at the forefront of that. And when Maker switched to Sky in the fall, they turned off the buyback. You can directly see the time in the chart where that happened, and lo and behold, they turned it back on a couple weeks ago. You can also see the direct impact of that on the chart. I think that as things come back and the market generally comes back, those are going to be the things that do the best.
The super powerful thing about like the combination of like maybe private credit or like just things that are further out the risk curve on the credit side combined with stablecoins is if you have a stablecoin with like, call it like $10 billion of scale like Sky has, you're really kind of processing redemptions on the order of like maybe 10%, or 20% a year. It's not like everyone's kind of like coming all the way in and then going all the way out. Like you need to have the cash, and they have like 5.8 billion of USDC today in their PSM, which is their peg stability module. But that will go into these higher yielding assets, and like you can really go far out the risk curve with like a slice of it. And say something like Apollo private credit, if that comes on chain, Sky can allocate a few $1 billion to that. That's probably mid-teens yield, and they pass that back to people in a stablecoin. And like, I don't know what you guys do with your cash, but like in JP Morgan, it's like, do you want to lock it up in a CD, or do you want to get shilled one of their private credit funds? It's like all of this stuff is way too complicated. A stablecoin that you can just take and stake and earn the yield from just tranches of different risk on private credit is the end game for all crypto. Like we used to have like Bitcoin, which is getting money and state decoupled, but I think kind of the heretical thing is like modern USD on blockchain rails with like high yielding, high quality private credit backing is probably one of the world's most interesting financial instruments today.
This episode is brought to you by Marinade. Marinade is a high-performance staking delegation platform that brings both liquidity and security to the Solana network by connecting SOL holders with the best staking rates on Solana. Follow the link in today's show notes to learn more.
I'm not sure how familiar with folks are in this audience with Sky or Maker and the history, but just to give a brief 30-second history of Sky and what the protocol looks like today is, Sky was a CDP protocol where you could initially deposit Ethereum and you can get a loan in DAI, which is the native stablecoin at the time. That has since expanded because there was a limited market of people that wanted to deposit ETH and essentially get leverage on that in the form of DAI, and so they've now brought on a whole bunch of real-world assets that generate a yield. And so Sky is this very interesting mix of a decentralized protocol where anyone can interact with the smart contract that mints DAI, but there's like a whole different portfolio of real-world assets, and it's now a capital allocation question from the Sky perspective. And so we've got treasuries in there, there's USDC in the peg stability module that you mentioned, Vance, and there's a new form of RWA, like an energy source of yield, which is being brought on chain. You guys were telling me about this backstage. This is super interesting. Can you detail the energy use case here?
So this is actually, I think, the first real world asset, because everything else is called RWAs, but it's really just like tokenized T-bills or private credit. But there are a couple of protocols, and Daylight is one of them that's working on this, where you're actually able to take, as an example, real world energy that is being generated in the form, in this case, of solar and then power storage, where residences in the United States will basically work with an installer, and the protocol will help facilitate this, where they actually own and operate solar panels that are put on top of people's roofs. And they're going to start in a few states. It's going to come out in a couple of months. But the idea is you can put solar on top of someone's house. You can start generating revenue. It gets stored in the battery that they then also install maybe in someone's garage. And if you form enough of these, you can develop what's called a power purchase agreement, a PPA, where you can sell all of this energy back to the local utilities. And that's a form of revenue that's always on. As long as the sun rises and you have access to it, you're able to generate some revenue. But the other aspect that's really interesting, and what they're also facilitating, is in the United States, there's what's called an ITC, an incentive tax credit. So for all the cost of the solar, as well as the battery, and the install cost, you get a 30% credit for the cost of installing that solar. And that is something that you can sell to a second, a third party. You can finance it, so maybe 30%, you get 25% immediately off the top. You can also depreciate it, and someone will buy that depreciation as another tax incentive. And when we're talking about how do you move maybe further from just T-bills on chain, wherever the Fed funds rate is, maybe into private credit, a little bit further out the risk curve, higher yield, differentiated sources of yield. I mean, this is like the connecting the digital to the analog in a perfect way, where the yields, are in the 30s to 40s% based off of a lot of these combined and bundled into this ecosystem. And there are a number of kind of tranched CLO type products that trade in other industries for solar, or other in traditional markets for solar. But this will be the first one that's on chain, and Maker is definitely going to be a facilitator of it.
Yeah, it's a very interesting framework, right? I'm not sure how many people have this, in their mind, but you can kind of think about all of these distinct sources of yield, some of which exist on-chain, some of which exist off-chain, and what Maker is doing and other protocols like it are importing those yields from a more traditional financial set of infrastructures into crypto, which is a super cool concept, and in that framework, Sky acts as a capital allocator, which is fascinating.
Exactly. If you think about kind of like after 2008, when all the private equity firms started their own insurance companies, like those are the things that really drove the AUM and the profitability and the scale of those firms. And it is also the thing that allowed them to take a lot of risk, because like the more AUM you have, kind of the more risk you can take. And there is like this reflexive flywheel that happens when that is the case. And I think stablecoins is basically running that back on chain, where you can decide to like tokenize private credit and put it on chain, but if somebody wants to redeem from that and it's just a standalone asset, like it's just not going to work that well. Like tokenization does not always imply liquidity at NAV. But when you have a stablecoin and you can package that into the backing, like that becomes kind of like the insurance company that's going to feed the growth of these like private credit vehicles. And a lot of people talk about like just like this tokenization wave and putting things on chain, and that's great, but like somebody needs to actually be the buyer, packager, and redeemer of the actual collateral, and that's what stablecoins, specifically Sky, is doing. And I don't think anybody ever unseats Tether. It's not going anywhere. It's it's just dominant. It's so dominant because it's so dominant. But the race for number 2, it's kind of more unclear to me. It's like, does USDC really have that big of a mode, that big of a business, or is something that's yield bearing and that's dynamic and global going to take over? And I would bet on USDS and Sky doing that.
Hey everyone, quick shout out to today's sponsor, Marinade. Since launching in 2021, Marinade has expanded their suite of products to provide solutions for both DeFi users and TradFi, including liquid and native staking, as well as direct enterprise integrations. Marinade's platform is optimized for institutions to securely expand their exposure to Solana. Whether through the provisioning of custodial or non-custodial yield, integrating staking rewards into Solana financial products, or leveraging Marinade's best-in-market rewards rate for revenue and treasury management. Whether you're in DeFi, TradFi, or somewhere in between, Marinade has something for you. To learn more about Marinade, follow the link in today's show notes.
Let's talk about stablecoins in general and where you think this market is headed. So for folks out there who might be a little bit less familiar, there's kind of I think you'd bucket 2 different groups of stablecoins. There's USDT and USDC, right, which they don't pass any yield back onto their users. And then there's a whole new class of like the USDSs of the world, which do pass yield back.
Well, you could probably say USDC does. I mean, you could hold USDC on Coinbase, or you definitely can get USDC yield. It just comes in different forms.
That's a good point. But it doesn't pass back to I guess if you custody on Coinbase.
Right.
But there have been a couple of speakers over the course of yesterday and today that were predicting there's going to be more stablecoin entrants. So Brian Moynihan, recently the CEO of Bank of America, has said that they would consider launching a stablecoin if the regulation permitted in the U.S.
Yep.
So I think we can pretty safely bet over the next 5 or 10 years a lot of new issuers. So I'd be curious, how do you slice up that world? Where are and how does just the market share change from what it looks like today?
I think stablecoins are really about 2 different vectors. One of them is kind of disparate growth. So where can you use it?
Yeah.
What is it? Is it integrated into DeFi? The reason why Maker and Sky have taken off is because DAI was one of the first stablecoins, and it was deeply integrated into basically every single piece of DeFi infrastructure. USDC is redeemable for $1. It's integrated into every U.S. exchange. You can get yield if you hold it in a U.S. exchange, and it's sort of the tokenized dollars is how I would look at it. USDT just has this historical precedent. To Vance's point, the reason why it's so big is because it's so big. It's like this network effect that is extremely strong and extremely entrenched. I mean, there was someone that we were close with went to Kowloon in Hong Kong a few years ago, and the values that they're quoting for the different currency exchanges are literally denominated in USDT.
Yeah.
And that's a traditional currency market. And so I think you kind of have these areas of growth, these vectors of growth, but then it's going to become a question of what can you actually get from them. And if it really is just tokenized dollars, it doesn't really matter to me whether or not I hold B of A coin or JPM coin. Like it totally doesn't matter unless I can get something additional from it. And so I think product differentiation is the second vector, and we're starting to see that a little bit with USDS and the capabilities that you get if you put it into the staking rate. But as long as it's secure and as long as it's geographically or product-wise diverse and capable of being used anywhere, then it becomes a question of what can I get from it. So yeah.
So a couple of just thoughts is one, I mean, if you have a bunch of new stablecoin issuers, at what point do we just stop calling them, JPM coin or USD or at some point it's got to be USD, right? You can't keep that many different coins in your head at any one given time.
Well, there's Curve, for this entire purpose.
Yeah, 100%. I don't know what's going on with Curve these days. I'm not going to
Who knows?
That's a stablecoin exchange. But the other thing too that when you look at USDT and USDC, I think a common element of those success stories is that they became trading pairs.
Yep.
So USDT became a huge trading pair on offshore exchanges. USDC is still like one of the stickiest parts of that stablecoin. I think is its place in decentralized finance. That'd be a very difficult thing to get unseated at this point. So when you look out into the world of new issuers, maybe exchanges like new exchanges, right, that are moving into this space could issue a stable and have it become a trading pair and get sticky that way. One other thing that we haven't really seen is the big payment networks really lean into this space yet. PayPal, right? But even like Venmo, right? Venmo, you've got crypto on Venmo, but it's in its own separate tab. Like I should be the exact user for this, and I've clicked on that once just to look at it.
So I think this is actually like the best, kind of like counterpoint to maybe there being 1,000 different stable coins.
Yeah.
Because look at PayPal. I don't even know what the value of it is right now, but it's de minimis. It's a rounding error in comparison to basically all the three major stable coins. And you can also get yield with PayUSD or PayUSD, and I think it just hasn't taken off because it doesn't have the same kind of network effect. It doesn't have the same reach that you have with the other ones, and that is such a hard network to displace.
You know what though? There are actually there are tens of thousands of issuers of like stablecoin dollars that exist today, right? Technically, dollars aren't fungible, right? Every single dollar is an IOU from a specific commercial bank. There's just a layer of infrastructure underneath the commercial banking system that backstops it, and so they've abstracted that away from you as a user. Like, I would imagine the same thing roughly happens with stablecoins, but maybe instead of the government bailing out a bank whenever it goes under, maybe there's a technology solution, or maybe there isn't, and the US just backstops that.
No more bailouts. I think like one thing that I think a lot about is at some point there will be treasury auctions on chain. Like this industry will grow large enough that the Fed will actually issue and redeem bonds on chain. I do think there is this moment where, like take Tether for example, you have USDT on chain, that's $1. Then you have the treasury bill that's sitting in the Tether account, that's another $1. And then say you can swap USDT for a T-bill on chain without redemption of that USDT, like you've then rehypothecated $1. And that is like kind of like the stablecoin singularity, like when we just don't go backwards ever before because there's just not just more capital efficiency, but like additional leverage that's implied in the system. And I think that's like probably 3 or 4 years away, but it'll happen. We'll get there.
Traders, AI enthusiasts, and degens, listen up. The game is changing, and Desk is leading the charge. To celebrate their launch, Desk is running a trading campaign with 3 major highlights. 38% of their token supply will be allocated to airdrops. They're offering the lowest trading fees on Earth, and finally, they will be running a Desk referral program. The more people you invite, the bigger your rewards will be. To get started, click the link in the show notes below and make sure to follow at Trade on Desk. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today.
We started this conference off by saying there's a big divergence in sentiment between the institutional part of this industry and the more retail kind of crypto native part of the industry. And I think part of that actually is that, okay, RWAs and stablecoins are working, but what do I buy? How How do I make monies on this?
USDC, no. I think like
USDT to $5.
yeah, people are searching for like who are the serious people in this industry, and like Michael and I came up in retail. Like we were trading crypto in Michael's mom's basement for a long, long time, so like we understand what it's like. But I think what the reality of the industry is today is that we understand which business models work, we understand how to pass back value to token holders, and we understand which tokens are capable of doing both at scale and with growth and with a reliable moat. And so, yeah, I mean, you got to be in one of those 4 or 5 assets. Like there isn't an investable universe of thousands of tokens, even though it may appear so. And every single time, like, in order for things to stay the same in terms of like the dynamism and the up-only price action and everything interesting, like things do need to change. And I think right now it's like, can we get a stablecoin large enough to dictate terms to traditional finance, to bring things on chain and have no redeemability, to rehypothecate things to get to the singularity? And I think we can. It's just going to take time.
I think in talking about the tale of two cities of like retail versus institutional, institutions, you know, are looking for bips or you know, maybe even percentage points difference, and that's a huge, you know, thing for them if they can get the scale that they're operating under. And that's where, you know, real world assets has really started with treasuries and maybe some private credit moving further out the risk curve. But when you're a retail audience, you're looking for something that's going to go 10x, not, you know, earn you 10% over the next 3 years. And I think what we're going to start to see as we move further and further up the risk curve of what can get tokenized, if we're talking about, you know, real world energy, let's call it, and you're able to actually get, you know, reliable, real world, differentiated sources of income at, you know, 10, 30, you know, 40% yield, that is an attractive product that nobody else really has access to if you're a retail customer in, you know, a retail setting. And so I think as we move into more bespoke and interesting assets to tokenize, that's where you start to see the retail adoption come on chain. And that's where you can differentiate between kind of the institutional perspective and the retail perspective. But there's go figure why people were trading meme coins, because, you know, they could flip it for 2x and you know, call it a day. And that's what they're playing for. But I think a 4.5% T-bill on chain is just so uninteresting.
Yeah, I feel like we've learned time and time again there have been some of these fixed yield protocols which have stripped out the principal and the variable, and, you know, the principal is this kind of, you know, steady 4 to 5% yield, and then the variable is, you know, the lower part of the capital structure, which is way more variable. And we've always thought that you'd opt into the, you know, the PT, and everyone YOLOs into the.
Just keep in mind, we're the least patient industry in the entire world. So
yeah, maybe that has to do with everyone's on Twitter constantly all the time. That doesn't help.
I do think it's likely, like, people think we're going to reinvent the future of payments. I think that is probably 90% chance going to happen with stablecoins. I think it's equally as likely that we reinvent private credit by accident. Like, a lot of bespoke, interesting deal flow comes on chain, is packaged in a stablecoin and distributed globally, and like, that is the real sci-fi stuff that I love and Michael loves too, and I'm sure you as well. And like, that's why we do it. We love it. We love crypto.
Hell yeah. Note of optimism to end on. Guys, this has been a ton of fun. Everyone, thanks very much for listening.